You see the headline, right? Some company wins a massive billion-dollar contract. We see the revenue, we see the stock price jump. But what is the real cost? In some of the world's most high-stakes industries, the price of a deal isn't always what you see on the balance sheet. It can involve these hidden risks that can just sink a company's reputation and its stock price, literally overnight. So, how do we finally measure something as murky and complex as corruption? Well, let's find out.
All right, so here's our game plan. First, we're going to look at the new rulebook that's changing how companies even report these kinds of risks. Then, we'll zoom right in on the high-stakes world of oil and gas services. We'll follow the money to see exactly how corruption is tracked. We'll explore the standards that are now demanding transparency. And finally, we'll connect all the dots to see why this matters so much, way beyond the financial statements.
Okay, so to really get our heads around this, we have to start with the rulebook. For years, anytime companies talked about sustainability or ethical risk, it was a lot of corporate jargon, pretty vague stuff. But recently, a new, standardized language has started to emerge, and it's allowing investors to finally compare companies on these critical issues, apples to apples.
And that new language is built on something called the SASB standards. Now, the crucial thing to get here is that these are not just some niche guidelines anymore. They've been integrated into the IFRS Foundation. That's the same body that sets global accounting standards for pretty much everyone. And this is a huge deal. It means these sustainability metrics are moving from the sidelines right into the main event, becoming a core part of how a company's performance is judged.
So what are they exactly? Well, think of them as 77 unique playbooks, one for every single industry out there from software to mining. Each one is totally laser-focused on identifying the sustainability issues that can actually impact the bottom line. We're talking things that affect cash flow, a company's access to finance, or its cost of capital. The key takeaway here is financial materiality. This isn't just about PR, it's about protecting the business.
So now let's see how these standards actually work in the real world. We're going to zoom in on a perfect case study, the oil and gas services sector. This is a global industry where the stakes, they just couldn't be any higher.
So who are these guys? These are the companies doing the real heavy lifting for the big oil producers. They're the ones drilling the wells, building these absolutely massive offshore rigs, and providing all those critical support services. They operate all over the globe, often in some really challenging places. And look, they don't just compete on who has the lowest price. Their success really hinges on their safety record, their technology, and, most importantly for our story, their reputation.
And that focus on reputation brings us right to the core issue. I mean, think about it. When you're trying to secure these huge, multi-million-dollar contracts with governments and state-owned oil companies all around the world, the risk of bribery and corruption becomes a major factor. And hey, don't just take my word for it. This quote from the SASB standard itself just puts it out there, plain and simple. For this industry, bribery isn't some abstract ethical concern. Nope, it is a known, significant business risk. If you violate anti-corruption laws, you're looking at massive penalties, and you can absolutely destroy that reputation that you compete on. So this leads us to the key question for any investor, right? How do you look at an annual report and actually see this risk? How in the world can you possibly quantify a company's exposure to environments that are potentially corrupt?
The answer, and this is pretty incredible, is in a specific quantitative metric. The SASB standard requires companies to disclose the exact amount of net revenue they earn from countries that have the 20 lowest rankings on Transparency International's Corruption Perception Index. And just like that, an abstract risk becomes a hard number on a page, measured in dollars, euros, or whatever currency they use. You can actually see it.
But reporting a number like that is really just step one. The standard demands a lot more than just identifying the risk. It requires companies to show their work and explain what they're actually doing to manage this exposure.
You see, it's not enough to just state the risk. Investors and regulators, they need to see the systems and controls a company has in place to prevent bribery and corruption. And not just within their own walls, but across their entire value chain, from employees to local partners and subcontractors.
And the standard actually outlines what a robust system should look like. It includes things like training programs to build awareness among employees. You need confidential channels for people to report violations, and of course, clear, explicit anti-corruption policies. It also points them toward aligning with big international frameworks, like the Extractive Industry Transparency Initiative, or ETITI, to make sure payments to governments are out in the open.
Okay, so let's bring all this together. How does all this transparency really connect back to a company's bottom line and its very license to operate in the first place? Well, the cost of getting this wrong it's just enormous. We're talking about significant fines and legal fees from violations, sure, but also higher ongoing costs just to manage compliance. And even more than that, a corruption scandal can have a devastating effect on a company's reputation, which, as we saw, is a key competitive advantage. It can even threaten what's called a company's social license to operate. That's the basic trust from communities and governments that allows them to do business at all.
Ultimately, business ethics doesn't exist in a vacuum. A failure in this area is directly linked to legal and regulatory risk. It's also connected to what we call critical incident risk. I mean, think about it. A culture that tolerates cutting corners on ethics is probably one that might also cut corners on safety, and that can lead to potentially catastrophic results. It's all part of the same puzzle.
That leaves us with one final thought. Thanks to standards like these, we can now see where a company's money is coming from with more clarity than we've ever had before. And it forces us to ask a really fundamental question. If a company's profits are heavily reliant on doing business in the world's most corrupt regions, what is the true hidden price of its success?